Today, we are doing a detailed sector analysis right into the core of the internet content and information landscape. You gave us a pile of sources, fundamental reports, technical charts, all of it on three really relevant but wildly different tickers. We've got the Titans, GOOGL, and Meta, and then this high-flying newcomer, WSHP. Our mission is to pull out the critical metrics, the key insights from all this data, and give you a full, unbiased picture of what's really driving this sector right now. Okay, let's unpack this.
Yeah, and we approach this pretty rigorously. We synthesize, the core financial statements, deep valuation metrics, technical momentum, and we filtered everything through a screener that looked for stocks in this industry with significant volume and a price over $10. And just to be clear, this deep dive is strictly for educational and analytical purposes. We're just interpreting the data provided. So any talk about profit or loss is, purely for illustration using hypothetical paper money. It is absolutely not investment advice.
Right. And that paper money experiment is what's going to tie this all together, I think, pretty dramatically. We're taking a hypothetical $5,000 and running it through the performance metrics for each stock over the recent period defined in our sources. We really want to see how wildly different the outcomes can be, even inside the same industry. So let's start with the undisputed momentum leader right now, Alphabet Inc., traded as UOGL.
GOOGL is, it's just a colossal entity within communication services. It's currently got a market cap north of $3.5 trillion. It really sets the standard for financial health in the whole sector.
The performance data we have is just stunning. The stock is showing classic runaway momentum. The last close in our data was 92.81, which is already up 3% on that day alone. But look at the trajectory. Performance for the quarter is a massive plus 46.59%, and year-to-date, it's up over 54%.
Yeah, it is.
And it's basically hugging its 52-week high, only a fraction of a percent away from setting new records.
Technically, the picture is almost textbook bullish. If you're someone who tracks momentum, all the signals are green. The stock's trading way above all its major moving averages, including the SMA 200, that long-term benchmark. The price is sitting 47.65% above that.
Wow.
And the relative strength index, the RSI 14, that short-term momentum gauge, it stands really strong at 66.08. So that signals powerful upward momentum, but it hasn't technically hit that overbought level of 70 yet, which implies, based purely on technicals, there might still be room to run.
So what's the fundamental story that's propping all this momentum up? Our sources just keep pointing to one thing over and over: AI dominance.
Precisely. The whole narrative recently has been dominated by the release of Gemini 3.0. The sources are using phrases like rave reviews, and they're crediting the product with turning GOOGL into a record-breaking stock.
So analysts are playing catch-up.
Yeah, they're rushing to catch up. We saw Loop Capital upgrade the rating from hold to buy just recently, and they raised their price target to $320. Overall, the analyst consensus is a very strong 1.45 rating, and they're aiming for a target price of about $324.
Okay, so the news narrative lines up perfectly with the technicals. Now let's look at the financial health. Does that strength go deeper than just the headlines?
Oh, it absolutely does. GOOGL shows exceptional profitability for a company of its scale. Its profit margin is 32.23%, and the return on equity, the ROE, is 35.45%. And on top of that, the balance sheet is just rock solid. Liquidity ratios are a healthy quick ratio. Current ratio are both 1.75. That means they have plenty of resources to cover any short-term liabilities. And critically, debt is negligible, a debt-to-equity ratio of just 0.11.
So financial health is pristine, momentum is relentless. That's got to suggest a premium valuation. What do the multiples tell us?
The valuation is, I'd say, reasonable, though not cheap. The trailing PE is 28.88. What's interesting is the forward PE drops a little to 26.29. That suggests analysts expect earnings to keep growing, which kind of justifies the current price. But this is where the deeper dive really pays off, because we found two crucial caveats hiding in these numbers.
Okay, let's get into those. What did you find?
First, the growth rate projection is slowing down pretty dramatically. While the company's annual EPS growth over the past 5 years averaged nearly 27%, the projection for next year is a relatively modest 5.28%. This suggests the market might be, shifting its view on GOOGL, moving from a high-growth AI pure play to maybe a mature infrastructure utility that just generates enormous stable cash flows, but at a slower pace.
That's a really key piece of context. And the second caveat has to do with the insiders themselves, right?
Yeah. Yes, and this is the fundamental paradox here. While the price is rocketing up based on all this AI enthusiasm, our data shows a consistent pattern of selling by key insiders. We're talking the CEO, Sundar Pichai, and others, all executing sales throughout the most recent months, November, October, September, and so on.
Wait, hold on. Pristine financials, huge momentum, but the people who know the company best are consistently de-risking their own portfolios. That sounds like the executives are taking money off the table, maybe because they know something the retail market hasn't quite grasped yet. Or maybe they just think this run-up is unsustainable. How do you weigh that continuous insider selling against all the public euphoria around Gemini?
It creates a fascinating tension, doesn't it? It might just signal a mature company strategy where executives are diversifying their immense wealth, knowing the stock has appreciated so much. But for you, the learner, observing the market, it raises a necessary red flag. The market's being driven by this unquantifiable future excitement around AI. And that often leads to moments where executives believe the price has peaked, at least temporarily, regardless of the underlying quality of the business. It's something to watch, even if it hasn't slowed the stock down yet.
All right, let's see the spectacular result of that AI-fueled momentum in our paper money test. Using that plus 46.59% quarterly gain, we calculate our $5,000 investment would have bought approximately 25 shares at the estimated start price for the quarter.
And based on that gain, that $5,000 paper investment would have swelled to approximately $7,320.25. So that's a substantial paper profit of $2,320.25. It just shows the sheer power of an AI narrative driving a fundamentally sound company.
Okay, now we pivot hard. If GOOGL is the picture of relentless AI momentum, our second stock, Meta Platforms, shows a completely different narrative. This is the momentum reversal. Meta is also a massive player, a $1.48 trillion market cap, but it's currently struggling with some severe selling pressure.
Yeah, the contrast in the technical charts could not be sharper. Meta recently closed at $590.32, down over 1% on the day. And look at the recent trend. Performance for the month is a sharp minus 19.49%, and performance for the quarter is a loss of 20.13%.
And it's way off its 52-week high.
Dramatically. It's down almost 26% from its high of 796.
That kind of steep, short-term drop for a mega-cap company like this raises a big question. Is the market overreacting? Or is this the confirmation of a serious, sustained trend reversal?
The technical indicators suggest serious pain. The RSI 14 is extremely low. It's sunk down to 23.32. Anything below 30 is considered deep and oversold territory. The price is also trading below all of its major moving averages, the SMA 20, SMA 50, and the SMA 200. This is just a visual confirmation of aggressive, persistent selling.
And yet, Meta had a huge piece of positive structural news that you'd think would have supported the price. They just won that historic FTC antitrust trial, confirming they get to keep Instagram and WhatsApp. I mean, that's a massive regulatory hurdle cleared.
That should have been a major catalyst upwards, yeah. But the positive structural news was completely overpowered by the negative narrative around AI. The market punished Meta for the perceived costs related to AI spending, rather than rewarding the regulatory win. And this concern was compounded by the reported departure of their chief AI scientist for a new venture, which hit the news at the same time. It just signaled a lot of anxiety about the company's execution and its long-term AI strategy.
So GOOGL gets rewarded for AI results, while Meta gets punished for the perception of AI costs. That's a fascinating split in the exact same sector. But if we look underneath the price action, the underlying financials for Meta still look incredibly robust.
They absolutely do. Despite the short-term slump, Meta maintains superior gross margins at 82% and operating margins at 43.28%. Both of those are higher than GOOGL's figures. And on top of that, the valuation multiples are more attractive. Meta's trailing PE of 26 and its forward PE of 19.87 are both lower than GOOGL's. It suggests the stock is fundamentally cheaper on an earnings basis, and future EPS growth is projected strongly at almost 30%.
Okay, so superior margins, cheaper valuation, fantastic projected growth. And yet the stock has dropped 20% a quarter. What was the precise financial data point that triggered such a severe reaction if the underlying health is so strong?
The primary pain point, the one that really broke the positive trend, was the recent earnings report. Our sources show the earnings per share quarter over quarter dropped sharply by a staggering 82.54%. And this correlated almost perfectly with an earnings surprise. So the difference between what was expected and what was reported of, minus 84.38%. It just indicates that recent results failed to meet analyst expectations by a massive margin. And when you couple that with the anxiety about AI spending, it just led to a deep, rapid correction. The market punished the surprise more than it rewarded the stability.
So let's quantify that punishment. Using that minus 20.13% quarterly loss, we estimate our $5,000 paper investment would have bought around 6.77 shares at the start of the quarter.
Right. And that $5,000 investment based on that steep decline would now be worth approximately $3,996.96. That translates to a paper loss of $1,003.04. It just starkly illustrates how quickly negative sentiment, fueled by an earnings miss, can erode value, even for a financially powerful company.
All right, now we move to our final entry, which represents the extreme opposite end of the spectrum. WSHP, We Shop Holdings. This is the profile of pure, high-risk speculation. It's a relatively tiny UK company focused on a shoppable social network with a market cap of just $4.6 billion.
Yeah, WSHP is defined entirely by extreme volatility. Its IPO on NASDAQ was very recent, November 14th, which just sets the stage for this kind of dramatic price action that's completely divorced from fundamentals. And the recent price action is, well, it's legendary. The stock closed at $200, but on that single trading day, it experienced an astonishing plus 506% change. It soared by $167.
A 500% gain in one day. That is the kind of move that grabs headlines and just draws in pure speculative fervor. The stock's riding the wave of its recent NASDAQ debut, promoting a new retail revolution. What does the technical chart even look like during that kind of vertical move?
The technical analysis here is sort of simplified by the sheer intensity of it. The closing price of $200 put the stock 233% above its previous 52-week high of 60. The candlestick pattern showed a pure white body, a classic sign, which analysts call a Marubozu white. It basically just means that buying pressure was relentless and dominated the price from the opening bell to the close. Relative volume was also extremely high, confirming intense public interest fueled this burst.
So the enthusiasm is just explosive. Now, for the crucial analytical step, is there anything under the hood to support this kind of valuation?
This is where context is absolutely vital. When we strip away the speculative narrative, the fundamentals expose just massive red flags, the kind that are typical of a brand new loss-making operation. The company is currently operating at a loss, with its trailing 12 months EPS at minus 61 cents.
And I'm guessing the valuation multiples are astronomical because the business isn't generating real income yet.
Exactly. They are completely disconnected from any established sales reality. The price-to-sales ratio is an astounding 4,400, and the price-to-book is over 900. This confirms the current valuation is based entirely on future hope and momentum, not current performance.
Let's focus on those profitability metrics you flagged. I mean, a company should make money, not just constantly lose it.
Correct. And the numbers here are just disastrous. The gross margin is negative 599%, and the profit margin is intensely negative at minus 1,366%.
A negative profit margin of over 1,300%. For you, the learner, what does a profit margin that low practically mean for operations?
It means, quite literally, that for every single dollar they manage to generate in revenue, they are currently spending $13.66 just to sustain their operations. That is a structurally and fundamentally unsound business model. They are burning cash at a pace that far, far exceeds their revenue generation.
And if that wasn't enough, what does the balance sheet say about their short-term ability to even survive?
The balance sheet shows serious weakness. The quick ratio, which measures a company's ability to meet immediate bills with liquid assets, is only 0.02. A quick ratio below 1 is worrying, 0.02 is catastrophic. It means they have next to no immediate liquidity to pay their bills. And compounding this, their debt to equity is quite high at 1.74. This combination of extreme losses, high debt, and abysmal liquidity suggests that massive price jump is purely speculative froth, completely divorced from operational reality.
All right, now for the most extreme paper money calculation of this entire deep dive. If an investor had bought $5,000 worth of WSHP at the previous day's close of $33, based on that incredible 506% gain in a single day.
The initial $5,000 investment would have purchased approximately 151.5 shares. When those shares closed at $200, the resulting position would be worth approximately $30,304. That demonstrates an explosive paper profit of $25,304 based on a single, highly irrational price move. It's the ultimate demonstration of the immense short-term risk-reward trade-off in these highly speculative IPOs.
What a spread of outcomes. I mean, if we pull back now and summarize these three profiles, it's so clear the internet content sector is highly bifurcated, and it's almost entirely based on the AI narrative.
Absolutely. We've seen three distinct models operating under the same sector umbrella. GOGL represents stability and AI execution. It combines strong, healthy fundamentals with unstoppable momentum, even with that paradox of the insider selling. Meta is the reversal story. A strong underlying financial engine, superior margins, low forward PE, but it's currently crippled by a narrative failure around AI cost anxiety and that devastating earnings miss.
And then you have WSHP, which is just pure narrative speculation. It offered a massive 500% daily gain, a huge short-term return, but is underpinned by terrifying fundamental metrics, a negative 1,300% profit margin, extreme debt, and essentially zero liquidity.
The knowledge to be gained here is just how crucial it is to look past the daily percentage changes and connect that technical reality to the financial health. GOGL's rise is fundamentally justified, Meta's fall is fundamentally questionable, and WSHP's rise is, well, fundamentally unsustainable without immediate radical change.
So what does this all mean for you, the learner, trying to navigate this sector? It means the market is currently rewarding successful AI implementation and just ruthlessly punishing perceived failure or cost inefficiency. The difference between a $2,300 profit and a $1,000 loss is often determined by sentiment around future strategy, not just current results.
And this raises an important question that you really have to consider. When a stock rockets by over 500% in a single day, as WSHP did, does that spectacular, massive short-term gain fundamentally alter the long-term viability suggested by its negative 1,366% profit margin and its abysmal liquidity?
That is the ultimate question of speculation versus fundamental value in the modern AI-driven market.